In the present context of economic instability, investing has become a basic human need and almost equal to survival. We all remember very well the spring quarantine in 2020. The consequences of such measures have been disastrous for some people and companies without a financial cushion. At such times, the value of investing is particularly acute. This article will look at traditional ways of investing, disclose the topic of investing in cryptocurrency, its advantages and disadvantages, and share the safety rules in such a complex matter as crypto investing. This is a channel about cryptocurrency, and today we will try to figure out who is cooler, mining or investing. We should note right away that the information we've got deals with investing, not trading. In this context, the investor can be called a holder, from the strategy of holding coins. It means that earning on the fall of the rate is not considered. Not to forget that miners can also sell their coins. When an investor can get the most out of their investment, a miner has to settle for just the coins that were mined at the time of the peak of the rate. Mining equipment is an asset that can be sold in the same way as cryptocurrency. Well, let's start with the investment. First things first, cryptocurrency is an electronic currency that exists only in virtually. Digital currency can be used to buy goods and services, to transfer a virtual asset to third persons, and to open cryptocurrency deposits. Before investing in digital currency, it is important for an investor to make an investment plan, find a safe exchange, have a wallet for storing virtual coins, and consider all the risks of investing in cryptocurrency. Pay attention! Most cryptocurrencies are not protected by anything, neither gold nor real investment assets like stocks, bonds, real estate. The main value of such digital coins is the trust of users. Bitcoin is an example of a cryptocurrency. Let's start with the analysis. Before buying a particular cryptocurrency, an investor should study the digital asset. The financial market distinguishes between fundamental and technical analysis. Fundamental analysis of a digital currency is a method of identifying the real value of a cryptocurrency and is used when making long-term financial investments. In order to fully understand the electronic coin market, this type of analysis includes an evaluation of the political and economic situations in the world, the prospects for cryptocurrency development, and of course user interest in the virtual asset. There are three parameters of cryptocurrency analysis. On-chain metrics. It helps to form a characteristic of the electronic asset with the help of data taken from the history of financial transactions of the cryptocurrency. Such information can include the number of transactions, their market value, the amount of commission, etc. Design metrics refers to the analysis of the purpose of creating a cryptocurrency. For this purpose, the technical documentation of the virtual coin is studied and the presence of competitors in the digital currency market is checked. Financial indicators. Data from this category is needed to find out the history of exchange trading on the investment asset. Settings that investors need are the market capitalization of the cryptocurrency, its liquidity, and the volume of daily trading. Today, there are many platforms in the digital currencies market that offer investors ready research on each virtual coin. The most popular services for fundamental analysis of cryptocurrencies are BaserInc and CryptoFees. Technical analysis of a digital coin is based on predicting the future movement of the market price of a cryptocurrency in the short term, up to 1 year. The main idea of technical analysis, the market value of an electronic asset, reflects everything that can affect its value. Therefore, investors are only interested in the price movement of the virtual coin. The main methods of technical analysis, trend lines, presented as slanted lines to reflect the maximum, resistance level, and minimum, support level, price of the asset. The moment to buy a digital currency is when the coin price is near the support level. Accordingly, the resistance level is the point at which it is worth selling the cryptocurrency. Fibonacci levels, presented as a set of horizontal lines and used to find a profitable entry point for a digital asset and to make a short-term investment. Elliott waves. Because exchange prices move in waves, this method of technical analysis allows you to find recurring trends on the charts and make predictions about the future movement of an exchange-traded asset. There are more technical analysis methods which reveal the direction of price movements. We have only considered the most popular ones. However, none of them is suitable for investors who buy cryptocurrency for a long term. Ways to invest in crypto. There are actually a lot of them. We have chosen for you the most popular at the moment. There are several promising options for investing in virtual coins. Let's study the main ways of investing. Ways to invest. At first glance, there are a lot of options. You can buy gold, shares of Apple, SpaceX, or other well-known technology companies, invest in real estate, or put a deposit in the bank. However, if you look closely at each of them, a number of obstacles arise. Real estate requires a significant financial investment. You can't buy a piece of corridor for a year's bonus at work. To buy stocks, you have to know the basic principles of the stock market and engage a broker, which requires a lot of effort and time. Gold, too, is not sold in small chunks in an underpass. The difficulty in acquiring the above assets and the financial barrier are not the only disadvantages. Liquidity is also an important issue. After all, if you urgently need cash in a few months, you won't be able to get it instantly for the above assets. Bitcoin and other cryptocurrencies as objects for investment. In November-December 2020, we saw another surge of interest in cryptocurrencies, pushing their quotes up. The second week of December 2020 showed unprecedented growth of Bitcoin. Its rate reached $23,000, and its total capitalization exceeded $400 billion. The statistics speak for itself. Over the past 2 years, the main cryptocurrency has risen by more than 600%, from $3,500 during the crypto winter in February 2019 to today, $23,000. Experts predict the mass spread of cryptocurrencies on par with the internet and estimate that by 2024 there will be 1 billion people using cryptocurrencies. Naturally, this will lead to an increase in investment interest from both ordinary people and companies. Trading. This variant of earnings is based on financial transactions with cryptocurrency on the principle buy low and sell high. Typically, the period of time between buying a digital currency and selling it lasts from a couple of seconds to several hours. So trading is based on technical analysis. Trading is considered a high-risk way of investing for first-time investors. The high volatility of coins affects the profitability. Cases of complete loss of financial capital are not uncommon. However, in a period without strong price fluctuations, it is possible to get up to 30% of profit and higher. Long-term strategy. People who make long-term investments in cryptocurrency are guided by the principle of earnings, buy and forget. The essence of long-term investing is to study a particular cryptocurrency, using fundamental analysis, then find a growth-promising digital asset and buy it. In this kind of investment strategy, the market value of a coin is only important to compare it to the real price of the crypto. If the market value is lower than the real value, the digital currency is undervalued and can be bought. With proper analysis of a cryptocurrency, the amount of income can usually exceed the investment by several times. Now let's switch ourselves to the mining. How mining works. In the process of servicing Bitcoin networks by users, new coins become available. This is mining, the principle of this phenomenon. The main function of mining is to add transfers to the Bitcoin registry. This requires performing complex mathematical tasks that only powerful computers that require a lot of energy can do. Nowadays, mining Bitcoins at home, alone, without special equipment is simply impossible. That is why there is a network of several powerful computers. Miners receive remuneration, which is getting smaller every year. Users join together in pools to continuously receive remuneration. This allows to break the task into small subtasks, which are solved gradually by pool participants. What is cryptocurrency mining? Mining the right digital code is what cryptocurrency mining is all about. So how does it work, and what is the meaning of cryptocurrency mining? In the process of mining, a structure is created to ensure the functioning of the entire system. In the course of collecting data on the latest moves into blocks to solve complex puzzles, the user who is the first to find a solution to the problem receives a reward, coins. The task comes down to finding the encrypted code. Who can do cryptocurrency mining? Everyone who has the appropriate equipment. Cryptocurrency mining today is possible not only in the form of Bitcoins, but also in the form of other alternative virtual units. Examples: Ravencoin, Ergo, Ethereum Classic, Litecoin. Who pays for mining? You might think that the essence of mining is getting money out of thin air. the logical question arises, why mine? What network members need the computations that powerful computers produce? Why pay for it? It's simple. It is necessary for those who use virtual currency in their organization. It is important to understand that blockchain is not a perpetual database. It can change and deteriorate over time. Only paying bills will help keep the information alive. If you think back to the function of mining and how it works, you can understand who needs the power of miners and why. Combining several machines in a network increases their power and increases the probability of a positive result, the decryption of the code. The operation collects data about the transaction and the movement of blocks of information, creating blockchains. This is what one gets rewarded for. Types of mining: solo mining, mining in a pool, and cloud mining. Let's start with solo mining. This is the process of mining cryptocurrency by yourself. This method will require you to be either very lucky or very powerful, commensurate with other users. You can try to mine solo. This way seems to me reasonable in case of new, not popular cryptocurrencies. This way has its pros and cons. Second method, mining in a pool. The development of equipment and increasing complexity has led to the emergence of mining pools. Single decrypting blocks was no longer profitable and became unprofitable. The solution was to combine the power of users into groups. Third method, cloud mining. The third way is cloud mining. How does it work? A miner uses a remote data center with shared processing power. There is no need to manage the equipment. This method is good for those who have high electricity rates. After learning about mining options, how can we start mining on our own? Before you start mining virtual money yourself, you need to understand the device of mining. You can choose a popular mining pool and become a new member. If you decide to do it on your own, you will have to spend a large sum to buy equipment. Because of the high competition, solo mining requires strong capacities. It is believed that mining farms are the profitable option today. So we come to the main question of today's video: mining or investing? We think that both options are not suitable for beginners. The choice in the pairing of mining as investments, we believe, depends on a number of factors. For example, it is worth to decide how quickly the user wants to reach the income. It is also necessary to specify the amount of capital for investments. Those who want to quickly reach the income, according to the expert, should pay attention to investments. At the same time, Artem Barger reminded of the risks of losing investments due to the high volatility of BTC. Mining, in his opinion, is more suitable for those who are looking for options for a stable income. However, one should keep in mind that it may take a long time from the moment of entering the market to getting the first net profit. We want to note that you can buy Bitcoin on the crypto exchange for any amount, while a video card for mining will cost a lot during a bull market. At the same time, to organize the mining of the cryptocurrency, you need to solve a number of technical issues. For example, it will be necessary to organize equipment cooling, as well as to ensure noise isolation and uninterrupted power supply. Invest and forget. Why don't you just try it? After all, the experts also believes that the organization of mining will require investing in the equipment a lot of money, and the payback period of the investment can be counted in months or even years. If you consider Bitcoin simply in terms of investment, everything here is much easier. You make a decision and buy a coin for the amount you have, and then just forget about BTC for a while. Here we'd recommend to forget exactly. That is not to react on current market conditions. You've already evaluated all pros and cons. You've made your decision. On that, abstract away and shift your attention to something else. In the long run, Bitcoin will rise. It is inevitable. Of course, both mining and investing have their pros and cons. And in practice, it's a completely different game, so it's up to you guys to decide.